So we just got finished doing our quarterly update for our investors, and I figured while I had my partners here, we would talk about kind of everything happening currently in the stock market, in real estate, maybe talk about gold a little bit. So that's what this piece is going to be focused on, and I'm going to start with you, Jerry. What is the deal with the stock market right now? I think a lot of people, are surprised that it rebounded the way it did, especially when everything feels very chaotic. What is going on? Do you feel comfortable with where it's at? Why is it where it's at? Can we get some education for all of us of what's going on?
The why part is easier than am I comfortable. The stock market's forward-looking, right? What happens on a day-to-day basis doesn't have much of an effect on prices in the market unless it changes what we think about the future. And so, when we went into COVID, there was a whole lot of uncertainty. And in fact, I think the last time we filmed was, pretty recent after COVID sort of started on come out. And so all that uncertainty, everybody was kind of wondering, okay, well, we're going into a shutdown. What does that mean? How long does that last? What does that do to consumer behavior? The brands that we've known, are they going to, survive? And, you had all of those kinds of questions. So some of those concerns are still out there. With the stimulus packages, that were previously passed running their course, and uncertainty about whether there's going to be more and how long is it going to be. Those stimulus packages helped a lot of people be able to keep on making purchases, paying their rent, buying stuff, and that kept the economy going. With that sort of falling off the books, if you will, how's that going to affect behavior? The market's holding up surprisingly well in the face of that. And really what, if you will, imply, sort of what the market believes based on that, seems to be that investors are largely counting on there will be some sort of additional stimulus coming in, and it'll come soon. Now, whether that actually happens or not is going to have very significant implications. So when you ask, am I comfortable? There's still a lot of uncertainty out there. And so, and I think that the optimism, if you will, that, is being priced into the market, I think, if I had to, weigh probabilities, I think they're probably right. I think that stimulus probably does happen. I think that, things probably do work out okay. And, we work through this and, times go to being good again. But there is a risk there, that maybe for whatever reason, politicians keep playing their politics, and that stimulus gets delayed and some damage gets done. And that's not really reflected in pricing in the market right now.
So for everybody watching that hears you say, yeah, there's some uncertainty and there's some things that we're just waiting to see what happens, what should they be doing right now? Is this a time where they should be a little hesitant on investing in the market, play the long game? What's your thought for them?
Yeah, good question. And the answer to that is always, it depends. It really depends on what's your starting point. Where are you right now? For the investor who maybe made the mistake of selling everything back when things were scary or scarier, during COVID, and they're watching the market run up and they're asking the question, do I get back in? Do I stay out? We're long-term investors. We didn't sell back then. We were buying more. We kind of looked at it as, the market's on sale, if you will. Today, if I was fully invested, would I be, buying on margin? Absolutely not. For me personally, I would not. But I'm not selling either. So I said it before. I kind of look at the market from the perspective of, regardless of what prices are at today, really the question is, what do I think things are going to look like 10 years from now? Are people still going to be buying stuff? If yes, well, I'm not too worried about a market meltdown. If are people going to still be buying the same stuff? Are they going to be buying more? What's that behavior going to look like? At the end of the day, that's what drives market prices, is consumer behavior. When people are still going out, you're still going out and buying, your car, you're still buying your groceries, you're still buying your clothes. All of those things, that we buy 10 years from now, as long as our population continues to grow, we're not only going to be buying that, we're going to be buying more of it. And so companies will be more profitable 10 years from now than they are today. As long as that's true, as long as we can have confidence in that, I'm less concerned about what prices are right now.
Well, and it's interesting because you had touched on this. When the markets go down, we're looking at that as the equivalent of, if Nordstrom is having a big sale on in their department stores, that's the opportunity that you go in and you want to buy. And oftentimes when it comes to investing in the markets, people tend to have the inverse reaction to market fluctuation, right? So markets go down, people tend to get fearful, and they respond by selling various positions that they have. And those that have sold at that time that are now asking the question that Jerry was referencing, which was, do I go in now, or are we headed in for another correction? That's a very stressful position to be in. And oftentimes the stress of trying to determine whether you go back into the market is more stressful than being in the market and just seeing your positions go down. And so it's very important to be mindful of that fear and greed emotional response to where the market goes, and not act on it. You always want to have a very clearly defined strategy. What is the purpose of my investment? What are my financial planning goals and objectives? And based on that, you create your strategy and you adhere to that strategy, and you don't let the market dictate what you actually do. So you don't want to respond to the market in a way that compromises what that goal is. We talked about how when the markets were going down, we bought multiple times. And that's what you want to do in situations like that.
So will you tell everybody the importance of, or the importance of the strategy of buying more when the market's down, because it actually helps your rebound, or you're able to get back what you lost in a quicker manner?
Yeah, so if you, I guess you can call it like dollar cost averaging, right? So if you purchase at 100, and then you purchase more at 75, and then you purchase more at 50, and then you purchase more at 25, and then it starts to turn, and you continue that approach. Your average purchase isn't 100, and it's not 25. It's kind of somewhere right there in the middle, right? And so as the stock, or the markets rebound, and then it exceeds the 100, well, you positioned yourself to make a good amount of money, and more importantly, you eliminated the guessing game of trying to time when it hit 25. And the market doesn't turn when it really turns. The market turns when the last person sells, right? And so that's important. And trying to figure out when that last person is going to sell their position, in my opinion, and I think that there are probably quite a bit of people that would agree with this, I don't think that there is any empirical or extensive data to support timing the market is an approach that actually works. I mean, would you agree with that one?
Yeah, I haven't seen an approach that works well, at least not predictably.
Yeah, it's tough. And we give this analogy often, right? I mean, you and I have talked about it before, which is, especially in LA, you're sitting on the 405, you're in bumper to bumper traffic. What do a lot of us try to do? We try to change lanes to beat traffic. It's the same thing, right? You try to time the market, you're trying to change direction to beat everybody else out. Well, sometimes that works. And what happens most of the time, the lane we just got out of ends up going, and we're kind of stuck in this position. And so timing the market is tricky, and there's a reason why we don't speculate in that way.
Yeah, and I think it holds true, the quote, time in the market is more important than timing the market, right? Moving on out of the stock market into real estate, there's a lot of people talking about the market crash, the housing market crash that's going to come in 2021. A lot of these like real estate gurus. And the big points that they're bringing up are, one, the percentage of delinquency on mortgage. And as we know, they haven't been clear on separating who is actually not paying because they can't pay, who's in forbearance, and also what legislation is going to look like to help that process. The other one we're hearing about is in a lot of areas there's a shortage, which is driving demand up, so price is going up. But is that demand created because of the eviction moratorium? And once that's released, do all of a sudden we see demand come down? And then I think third, and this is something that we just experienced in refining our last apartment building, requirements have increased. The lender's guidelines or the lender's requirements have tightened. So in theory, if it's harder to get loans, are there less loans made, which could potentially bring prices down? So overall, do you think we're going into a market crash, into a housing market crash, and why or why not? There's a lot there.
There's a lot there to unpack. Okay, so let's start with, first of all, I have to validate all those concerns. Okay, they're legitimate. You do have a lot of people on forbearances, some of those government mandated, and it's not possible right now for a lender to foreclose and evict, and so there's a pent-up supply that's ultimately going to have to get worked out. It's going to come onto the market, and that will have a negative impact on prices. So that's a very valid concern. Lender underwriting standards getting tighter, that does tend to be negative for real estate prices as well. Having said that, I disagree with the conclusion. I don't think we're coming up on a crash, and here's why. If you look back at 2007, 2008, and the government tried something new with their banking regulations. In previous market cycles, you had this boom and bust cycle that happened, and the bust was largely driven typically by lenders. So you get in the boom stages, lenders get very loose with their underwriting standards. We were seeing 3% down loans and no underwriting, stated income, all of that stuff was everywhere. And that ultimately comes with a price tag, right? When lenders aren't doing their underwriting, bad things are going to happen. So we saw prices run up in a real big way in response to the free credit that was out there. And then when the default cycle happened, lenders in the past have not been allowed to carry those on their balance sheet. You'd have, the Fed would come out and say, okay, you've got too much in non-performing loans. You must get those off your books immediately or face, takeover. We'll force you to be taken over by another bank. This last cycle was different. They looked at the banks and said, okay, hold on a second, let's rethink this. Instead of taking everything to market right now, push it through, get it off your books at any cost, they looked at the banks and said, tell you what, take your time, do it in an orderly fashion. Think through with each of these loans, where does this need to go? Does it need to go to a forbearance or a restructuring? Does it need to go through a foreclosure, and so on? And they allowed the banks to take a longer time to work those through. So we didn't get the sudden glut of inventory coming to the market. So you didn't have everybody suddenly displaced out of their homes. The impact on the economy was still significant, but we didn't see the kind of downturn in the real estate market that we had seen in previous cycles. It still went down, just not nearly as much. Let's contrast that with where we are today. The euphoria in the credit cycle didn't happen. Okay, you didn't have banks doing widespread stupid loans. The underwriting was still there. You had a lot of regulation that was put on the banks after the last cycle that prevented them from doing a lot of that, and that was probably a really good idea. The run-up, here recently, post-COVID, we're seeing in some markets a pretty steep run-up, and that is cause for some concern. But it's really not being driven by credit. It's really being driven by people leaving urban locations and moving to suburban locations, and you do see pricing adjusting both directions as a consequence of that movement. So I don't think that's necessarily a cause for fear or a cause to raise alarm. The foreclosures are going to happen. We are going to have a lot of people that have been displaced by COVID. That ultimately, the economy is going to have to get off of life support, the stimulus packages that the government has been putting out there to keep things moving. Those have to fade eventually, and not everyone who is currently in a home is going to be able to stay in their home. So there will be forbearances, there will be workouts, but some people are going to have to go through a foreclosure. The question is it going to be like, early cycles where we look, back a couple of cycles where the banks are forced to push those through quickly, or will it be more similar to the last cycle where the banks are given more leniency to do workouts and to bring those through the cycle on a more measured pace? I think it's more likely to be the latter. And so the result of all of that is I don't think you don't have the euphoric run up that led to previous crashes. You don't have the loose credit that led to sort of the crisis in the lending system. So I don't think that's what we're looking at coming into next year.
And you kind of touched on something where people are moving around a lot right now. Yeah. And us being in real estate, what are you looking for as far as location goes right now? We've always heard how important location is. But as people are migrating, what makes you feel comfortable moving forward on a project based on all the people going everywhere right now?
Yeah, well, like we talked about in the stock market, we're looking long term. Okay, so what's happening this year, what's happening next year, may or may not be an indication of what we can expect long run. When we're looking at a location, we're really looking at what are the drivers, for property values there. Jobs is a pretty common factor everywhere. What's happening with the employment base? How diversified is it? You have an area where say, aerospace, when they left Southern California in the early 90s, and you think about the impact that had on real estate prices in California. When you have those kinds of large concentrations of industry, you have to be worried about that. But other places where you have, typical of the more urban locations where you have really diversified employment base, growing employment, people are going to move where there are jobs. And so when you have those kinds of demographics, you can be a little bit more confident. And that's reflected in prices. You go into like downtown LA, cap rates are rock bottom, versus rural Montana, where cap rates are very, very high, because of the added risk there. So, but I mean, it's that kind of stuff that we're looking at. We want to know what are the demographics, what's it likely to look like, not just next year, but long term.
I guess one of the things I'm getting pretty often now, as we talk about real estate, we talk about the opportunity that we see in front of us, people want to get started. They want to participate. But they haven't necessarily gone through the difference between an active investor and a passive investor. They just know that they want to be involved. What are some decisions that people could ask themselves that would help them come to the best conclusion on if they want to be an active real estate investor or if they want to be a passive real estate investor? I guess either of you can run it.
How much Tylenol do you have in your medicine drawer? It's probably a good question. No.
So before we even go in, tell everyone the difference between an active or passive investor.
Well, so your active investor, by definition, is somebody who's going to be much more active in their real estate. They're going to be very involved in the day-to-day process. They're going to roll up their sleeves, work directly with the tenants, work directly with the property management companies, oversee the accounting process, directly be involved in the lending side of it, just soup to nuts, everything that's involved in real estate. And that is after acquisition. That's post-acquisition, right? We're not talking about all the pre-acquisition things that you need to do in terms of, identifying the property, going through the due diligence, doing the types of studies that you need to do, sourcing your lending. It's a long list.
It really comes down to one's a job.
Yeah.
You're going to be taking on a whole lot of work versus writing a check.
Yeah, and a lot of people tend to think that with real estate, it just kind of works on its own, and you have to put up the money, and then you kind of forget about it. That's a challenging proposition, and it's typically pretty untrue. There is quite a bit of work that goes into real estate when you want to do it well, when you want to maintain the property, when you're looking for identifying a good exit strategy in the property. There's a lot of thought and actual execution that goes into that. And so the active investor is ultimately going to be the one who's willing to undertake that work. The passive investor, by comparison, is the one, they have a full-time job. They have a career and they're successful in their career, and they've been fortunate to be able to save quite a bit of money, and now they want that money to work for them. And that individual is going to go out and seek a partner who has experience in a certain area of real estate that either they're interested in or could be interested in, and want to just deploy their capital and let it grow and eventually start generating cash flow for them.
So the big difference being, if you want a new job, you're going to be an active investor. If you don't want a new job, passive is probably the way for you.
In my experience in real estate, to manage real estate alongside a full-time job, that's a tall order.
Yeah. Maybe I should have asked this one when we were talking about the market, but in times of uncertainty, like we're in right now, what type of things do you see that people do wrong? What are some things that they could avoid, probably more emotional based, that puts them in a better position through this, not a negative one?
I would say, like so many things, what you did to prepare for that time is critical. And too many people are making bad decisions during the difficult times out of necessity. Okay, they don't have a choice. So if you went into that environment over leveraged, or without sufficient liquidity, you may find yourself in a situation where you're a forced seller, or you're in a foreclosure situation, even worse. So preparing for it is, number one. If you went in sufficiently prepared, now you're in a position where you have flexibility. You can take a step back, think, make smart choices, right? Those types of investors, the mistakes that they typically make are, like with everything else, fear and greed driven. And okay, I'm losing tenants, which we're not really seeing right now, unless maybe you're in retail. You start losing tenants. Maybe your property isn't generating positive cash flow anymore. Now what do you do? Do you stay put and work it out? Do you sell and move on to something else? Those are the kinds of questions that there's no one-size-fits-all, strategy or answer to it. You got to work through that. And if you're an active investor, that's part of the job, right? You've got to do your research, figure it out. The building's not going to lease itself back up. You've got to figure out, what do I need to do to get tenants in there, and do it. As a passive investor, it comes down to questions about how confident are you in your managers? Are you in the right place? Were they positioned right for it? Do they have the flexibility, or are they in a forced sales situation? Do you have confidence in their ability to, do the analysis and make good decisions and, represent your money well?
And sorry, just to add to that, for the passive investor, and we talked about this in the past too, if you were going to deploy your capital with a manager who's going to oversee your real estate investment, you should be asking a lot of questions. It's your money, and because it's your money, you need to know exactly how the manager prepares for uncertainties, what kind of uncertainties do they account for? What types of cash reserves do they hold into? How do they go about underwriting the property? What have they done when something has gone south, and how have they recovered from it? And get a degree of familiarity and comfort with that general partner to the point where you feel comfortable giving them your money. And I think that's probably a reluctancy that a lot of people have, is that because they're not familiar necessarily with real estate, or they get involved with a group that has a large portfolio, that because they don't understand as much, they don't feel necessarily comfortable asking the questions. You should definitely be asking those questions. It's important for you to know how they look at a situation and how they respond to situations.
Yeah, and I think too, just putting both of those together, when you talked about being prepared for these situations and then kind of making sure you're invested with the right people, one thing to consider is that something unexpected might go wrong, not only with your investment, but in your personal life as well. So making sure you have something like an emergency fund set up, make sure you have capital aside so that you're not putting all of your money into an investment where if something happens, you're not able to pull it out. So that's I think a good thing to consider as well.
Yeah, one of the things with holding on to cash that you often hear people think through and talk about is, if I hold on to cash, I'm losing out because of inflation and my money is losing. Cash is king, and cash will not only bail you out of a challenging situation, but cash will provide you opportunity that a lot of other people cannot get when markets go through some volatility, because that opportunity capital can make or break a lot of people.
Yeah, I agree. Opportunity capital for sure. We just don't want everything to always be in cash always. Right. This is the last time we did this was right as COVID was hitting, and we saw a lot of people start running to gold. Right. We talked about in times of uncertainty, that's where everybody heads. And then I called you, I don't know, 2 months ago or something. I was like, did you see Warren Buffett? Warren Buffett's buying gold. He hates gold, right? He was, investing in gold miners. So he's investing in business, but still. What's your thoughts on gold now? We've seen a huge spike since the last conversation. Would you still not invest in gold?
Always a hard one, right? First of all, I guess what I need to say is, last time we talked, I mentioned that my big objection to gold is it's not productive. You buy, if you buy the physical commodity, you get a piece of gold and it sits there. What are you going to do with it? It's not going to make more of itself, right? It's not going to do anything for you. It's just going to sit there. If you're actually dealing with the physical commodity, you have a cost. You have to worry about keeping it safe. You don't just take a piece of gold and set it on your dresser. That's especially if you're going to have a lot of it. You have to worry about theft. You have to make sure you keep it in safekeeping, and that costs money. You're going to be paying for small scale safe deposit box or something like that. And then you have opportunity cost. You tie your money up in that, and you're not doing something else. So I'm not a fan of gold for those reasons. That's not to say that there's not a place for gold in a portfolio. A lot of people look at gold as an inflation hedge or just a general diversifier. It does have a tendency to be non-correlated with other types of investments, and so it can provide some diversification benefits in small quantities in a portfolio. So I think there's a role for gold. Having said that, I don't like the idea of speculating on gold prices. What if you're wrong? What's going to drive that demand higher? And I've heard a lot of people come up with different stories over the years of why gold is going to go higher or why it's going to go lower. You go out there and you survey the market, and half the time they're right, half the time they're wrong. It's random. So I don't. When I'm making an investment, I want to make an investment in something that's going to be productive, something that like when we talk about real estate. Am I worried about what prices are going to do next year? No, I'm really not. What I'm worried about is the cash flow. Am I going to get the rents that I'm expecting? Am I going to have cash flow? Is there still going to be demand for this piece of property 10 years from now? Whatever prices do in the in-between, who cares? That cash is still coming in. If it's not a great time to sell, I wait till it is a great time to sell. and that's what drives my investment decisions. That kind of thinking doesn't work with gold.
Yeah, and from a behavioral standpoint, it's important to be mindful of identifying these trends and trying not to allow yourself to get sucked into the trend. And it's happened a lot of times in the past. It happened when COVID broke, and everybody ran to Costco and they were buying toilet paper in droves. Was there really any basis for it? Maybe for some people who needed toilet paper, sure. For others, they thought that toilet paper was going away for the foreseeable future, and they followed suit. And so what we had talked about earlier is critically important, developing a strategy and executing upon that strategy regardless of where the market goes and what it does. And so to Cherry's point, is there a place for gold in people's portfolio? Possibly, but for people to diversify away from everything else and go all into gold because they see Warren Buffett doing it, something that I personally wouldn't do.
Yeah. So that's a really good point. And segueing into the next question, for all these new investors, and you're seeing all these platforms come up, like Robinhood or kind of some of these fintech products that Gen Z is being a part of, and with social media and all this education around investing, you're seeing this new young group become excited. What advice could you give them moving into corrections, or that we know that it doesn't go like this forever, or at least there's always going to be these dips as it's moving up? What can you tell them as far as what do's and don'ts as moving into learning about investing or participating in investing?
You want me to start on this one? Well, the first thing I'll say is it is incredibly inspirational to see the Gen Zers and the young generation take such an interest in financial literacy and money principles. And unfortunately, it's not necessarily something that's taught in school. I didn't learn anything about money in elementary school, junior high, or high school. I learned with it once I got my first paycheck, and I said, what do I do with this thing? And my first reaction was, I'm gonna buy a car. I don't know that I would do that, now. I would start looking at it differently, and my relationship with money would be different had I received that education. And so to see young people take such an interest in money is a good thing for society as a whole. So to start there is really important. In terms of what they should be doing, continue that education process and understand that there's always going to be a degree of the market that is speculative, and it's going to react to that speculation. You'd reference this long-term graph, this linear graph that continues to grow. Sure, there's ebbs and flows inside of that, but long-term, and the reason why we invest long-term is because long-term we have seen over the past 100 years, it's continued to grow at a steady pace overall. So that's probably my feedback to a young person is continue to educate yourself, develop a strategy, and don't allow emotions to drive your decision-making process.
I'd echo that. And the single most important decision that an investor can make is to invest. Okay, manage your lifestyle in such a way that you have cash from your cash flow that you can save, and do it consistently. The biggest mistake people make is they go out and look for, get rich quick ideas. Okay, I'm going to buy this stock and it's going to go up so much. It's going to be the next, pick your flavor of the day, next Amazon or whatever. Don't do that. That's a bad idea. Most of the people who try and invest that way lose more money than they make. They shoot themselves in the foot. The most successful investors that I've seen over the years are, two varieties. One, these are people who know their business inside and out. Okay, they do a ton of research. They understand what they're investing in. They know what's moving those markets. They know the managers personally. They behave like a private equity investor, even though they're investing in stocks. They do very well. The other type of investor is at the opposite extreme. They just save their money. Okay, they buy an index fund or maybe an actively managed diversified fund, and they just keep saving. They get on a financial plan and put the blinders on, if you will, tune out the noise, and good times and bad, they just keep saving. We've seen teachers, people who've never made six figures in their life retire as multimillionaires just from that discipline. So for the average investor, that discipline is going to mean more than any other decision you make, whether you buy an index fund or an individual stock, or do I buy stocks or real estate. Those decisions pale in comparison to just establishing that discipline.
Hey Jared, how do you, I guess one question I would have for you is, in terms of how efficient the markets are, how efficient do you believe markets are right now, or in general?
Yeah, it depends on the market we're talking about. In general, typically when you hear arguments about market efficiency, they're talking about the U.S. stock market, right, and particularly with respect to like the S&P 500 or large cap, big companies. Those are pretty efficient. It's not perfectly efficient, but there's a high level of efficiency there. And for those who don't understand the jargon we're using here, what we're talking about is there a value to active management? Is there, or is everything that's known about a company already priced into its stock price? And so is there any benefit to picking, Apple versus Amazon versus Facebook, or do you just buy it all? The people who argue in favor of market efficiency will say, there are so many people paying so much attention to this. If you just buy some of everything, they're setting the prices for you. You'll probably do better by buying a very broad index fund. Keep your cost low. You'll probably do better than actively managing. And there's some good evidence for that for the average investor. But it's not perfectly efficient. There is value to a good active manager, like I mentioned before. The guys who go out and behave like private equity investors, and they really get to know those companies at a very, very deep level. They do add value, and they can do very well. The hard thing as an investor is knowing, which managers are going to add value and which ones won't. Which is why most advisors, Warren Buffett, I think, has said it over and over again. If you don't know, buy the index fund. You're probably best there. But I do think there's value to active management if you're up to doing the research.
So as everybody heard, there's a ton of wisdom here. I'm thankful to be able to hang out with these guys on the daily. But for everyone, if there's any more questions that you guys have from hearing this, leave them in the comments, and I will get these guys out here more often to start answering those. But again, we thank you guys for being a part of this. Please, if you can, like and subscribe to the channel. It does so much for us as far as getting this content out. And we will see you guys on the next video.